Next is the bond market. The bond market is for long-term instruments. It is for a capital market. So these are the bond instruments. 7. Treasury notes and bonds. Technically, treasury note, it has a maturity from 1 to 10 years. And we talk about a treasury bond. A treasury bond has a maturity of more than 10 years. Notes and bonds have exactly the same characteristics, coupon, interest rate, and everything else, except the only difference is a maturity. We make the difference to make clear. We call these intermediate term, we call these long term, and the other one are bills. So a very nice question for the quiz will be, what's the difference between a bill, note, and a bond? Okay, that's a simple, easy, straightforward question. They have all the other characteristics that we discussed about treasury bills. The difference is the maturity. Next one will be making a little bit, reshuffling a little bit from the table to fit these into the bond market. So next one will be municipal bonds. Are bonds issued by state and local governments. Now, very important to take note. Municipal bond is not issued by a municipality. Yes, municipality is a local government and municipality can issue a municipal bond. But municipal bond will include a state bond. It will also include a county issued bond issued by a county. So it could be a very small school district, it could be a county, it could be issued by a city. Okay? So it is issued by any type of local government except for the central government. Alright, so these are municipal bonds. Number 9, we call these agency debt or agency bond. Agency debt. Most commonly, the agency debt is in the form of bonds. These are issued by federal agencies. A federal agency is a government part or a government institution that has specific purpose. The purpose may be to stimulate housing, provide affordable housing. It may be to industrialize the economy, or it may be to stimulate a particular industry, education industry, healthcare industry. In general, it's an agency created by the government. It is a government agency with any particular purpose, like social purpose, and they will issue their own bonds. And the agency will be responsible for the payments, but a lot of time is thought or believed that it has the implicit backing of the central government. So they're almost as good as government notes and bonds, but not exactly, just slightly worse. Let's see. And the next one, the last one, is called corporate. Corporate bonds. These are bonds issued by corporations, including commercial banks. So commercial banks will have short-term instrument like CD or commercial paper, but the long-term instrument of the commercial bank is still a corporate bond. So these are issued by corporations or other financial institutions, including insurance companies and so forth. All right. So these four will be representing the bond market. Bond market is a capital market. Number 11. Number 11 will be mortgages. And there will be a special market called the mortgage market. A mortgage is a loan secured by real estate. Secured by real estate. Now, it is not, as most people think incorrectly, that it is a loan for the purchase of real estate. No, not true. A mortgage is a loan secured by real estate. You can go on vacation. You borrow money on vacation, you secure it with your house. Or it may be a medical loan. It's going to be pay your hospital for your liver or kidney or whatever medical procedure you need to do. Maybe you need $10,000, a lot of money. And you're going to have a mortgage loan. You're going to mortgage the house. Okay? So mortgages are secured with real estate. Real estate is usually in the forms of houses, apartments, or land. Okay? So that's a mortgage. Mortgages are traded on the mortgage market. Occasionally, mortgages may be packaged together and you're going to have mortgage bonds. And mortgage bond is a bond secured with mortgage loans. Could be part of securitization. We don't need in this course. Just need to understand the fundamental idea of a mortgage. Okay. Now, loans can be, let's go back here. Loans can be secured or unsecured. A loan is secured with an asset. Asset we call, let's do this. Asset is called collateral. So, collateral is an asset which secures a loan. The collateral could be financial. You can put dollars, yens. You can secure a loan with stock or bond, okay, if you have them. You can secure it with one of the better securities here in Thailand and most places around the world is gold. Very liquid. So, gold. Now, gold is considered a financial instrument and a financial asset. So, you can say financial and or gold, okay? It could be with real assets. Real assets will be machines, equipment, laptop, taxi, special crane, something else which is different. And again, don't confuse real assets with real estate. The difference between real asset and real estate is whether you can move it or not. Machine, you can move. Truck, you can move. Crane, you can move. Land, you cannot move. Now, the technical definition of real estate is whether you can move it without structurally breaking it. Yes, you can move your house from this place to that, but you'll have to unbuild the house, have to break the house, and have to rebuild it. Okay? So, real estate is you cannot move it without breaking it or some other. Real assets, you can move. Machine equipment, could be table, could be a projector, could be air conditioner, but usually we have a lot more other stuff. So these all serve as collateral, okay? And when the collateral is real estate, so in other words, when the loan is secured with real estate, we call it a mortgage. All right, let's see if we got anything else. So this, or these mortgages, will be represented here by this part. Now I can draw another nice clean line and get stocks 12. Common stock. And number 13, preferred stock. Preferred stock. These are jointly traded on the stock market. All right, so what is a common stock? Common stock refers to the pure ownership of a corporation. It is a claim on the earnings and assets of the corporation. The key I was explaining, let's see, right, okay, I can write over here. Stock, the key characteristic of a stock is residual claim. Stock gives you a residual claim. Residual claim means a claim on assets and income after all other obligations have been paid. In other words, it's a residual. Whatever is left over after you get paid for everything else. So it's a residual claim. So that's the first primary characteristic of a stock. The second very important characteristic is voting, as in voting rights. A stock owner has, for each share, the right to vote. If you have 50 shares, you have 50 voting rights. If you have 2,000 shares, you have 2,000 voting rights. And usually, you vote on all extremely important decisions, maybe merger, acquisition, whatever else. But the most commonly, you vote for board of directors. These are the people with supreme authority in the company, which act on behalf of shareholders and make all the strategic decisions. The major, again, merger, acquisition, pay dividend, make a major investment, maybe make any investment over a certain amount of money and so forth. Now, the board of directors in turn elect the CEO and maybe they elect other executives. So, corporate executive is a high-ranking officer in a corporation with significant decision power. So when you're a stockholder, common stock has voting and voting rights, okay? So these are the two primary characteristics. There are others, but that's not as important. Common stock is also known, I explained, as shares. Yeah, we can get back over here. Let's see what else we have here. Common stock is very risky. Okay? You can lose a lot of money on common stock. You can technically lose all of your money in a stock. If the company goes bankrupt, you lose everything. Mortgages are as risky as real estate. And until recently, most people believe, for some reason, strange, that real estate is safe. And it always goes up, 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 and up. It never goes down. Well, reality has always proven this to be wrong. The United States only for 100 years in the 19th century had 10 to 11 real estate crashes. During the 20th century, had 5 or 6 major real estate crashes. Real estate crashes regularly in China, regularly in Japan, regularly in Europe. In general, real estate crashes practically anywhere in the world on a regular basis. And sometimes it may recover in 2 years, sometimes it may take 10 years to recover, sometimes it may take 100 years to recover, and occasionally it can take more than 1,000 years to recover. Like Roman or Italian real estate, which was very expensive, 2,000 years ago, and as the Roman Empire crashed, it couldn't recover for another 1,000 years. Again, mortgages are just as risky as the real estate that backs it. All of these, the risk depends on we call it creditworthiness of the issuer. Treasury is supposed to be extremely low to no risk. Municipals are sometimes very low risk. A lot of times they're very high risk. Sometimes states and local governments, they go bankrupt. And sometimes they get bailed out by the central government, but a lot of times they don't get bailed out. So investors could lose money on these. Agency debt is considered to be very low because it's presumed that there is some guarantee by the central government so that if they go bad, the central government will bail them out. With corporate bonds, it's a little trickier. Usually it depends on the company's standing position, called financial position, but it will depend on whether the government will be willing to bail out the company, like Ford or Chrysler or GM. If the corporation is strategic or considered to be strategic for jobs, employment, national security, or military industrial contracts, the government will typically bail them out. So all of this is factored into the risk of default. And there are other risks. There's an inflation risk, there's a currency risk, there's a liquidity risk, all other risks. All I'm currently discussing is the one risk which I introduced out there, which is default risk. Let's see what else. Preferred stock has a dividend. Now here, let me write this one over here. Number 3 is dividend. The stockholder, the shareholder, is entitled to a dividend only if the board of directors declares the dividend. But the board of directors does not have to declare a dividend. If they got sufficient profits and there's sufficient amount of money left over, they'll distribute it as a dividend. But the dividend is not required. And the dividend is not guaranteed. Just because you bought a company, don't think that if they were paying a dividend before, that they will continue to pay. Usually the company desires and wants to keep paying if the company has the money. But if they don't have the money, they'll cut the dividend. Cutting the dividend means they'll reduce the dividend, or they may eliminate the dividend altogether temporarily until the company returns to profitability. All right, so going back to preferred, we got a separate what's called common dividend. Common dividend, which is dividend paid to common stock. And then they have preferred. Preferred dividend, which is dividend paid to preferred stock. And preferred dividend is usually stated or declared. It's given. Preferred dividend will be, let's say, 7%. It could be 5, it could be 4, it could be 3, it could be 9. So, preferred dividend or preferred stock as a somewhat guaranteed dividend of a certain percentage. And here's the trick. Sometimes the company may pay it, sometimes it may not pay it. So, if the company has money, it will pay the preferred dividend. If they pay, they must pay the stated amount. Otherwise, they don't have to pay. But here's the trick. This is where the preferred, this is the meaning of preferred. Preferred dividend means that all preferred dividends must be paid in full before any common dividend is paid. So common dividend has a low priority and preferred dividend has a higher priority. All preferred dividend must be paid. And usually preferred dividend is said or called to be, has the property of being cumulative. Cumulative means the following. If they decide not to pay 7% and next quarter not pay again, and next quarter not pay again, it is cumulative in the sense that everything that wasn't paid in the past must be eventually paid before, again, any common dividend is paid. When a dividend is not paid, we say that you skip a dividend. Skip means one time you don't pay. So, skipping preferred dividend, the payments accumulate, they add up. They must be eventually paid before common shareholders get anything. Now, preferred stock is called a, remember, where I have debt and equity? Is it here or on the back? Debt and equity. Alright, somewhere here I wrote debt and equity. Some instruments will have characteristics of both debt and equity at the same time. Preferred stock is such. It is an equity. It's a residual claim. But at the same time, they may get the dividend, they may not get the dividend. Okay, so it's just like a stock. But at the same time, it's got to pay 7% every single quarter. Or a quarter of 7%. So it's got characteristics of a fixed, same as debt, and it's got a characteristic of equity. We call this security hybrid. Hybrid. So, hybrid security or hybrid instrument is a financial instrument with characteristics of debt and characteristics of equity at the same time. Okay? So, it's kind of like in between. It has a characteristics of both. Alright, so preferred stock, going back, is usually, even in the textbook, written above. And these are in terms of liquidity and in terms of maturity. These are the shorter term, these are the longer term. The notes may be considered intermediate term, and these have typically no maturity. So I can write extra, no maturity. And we call this common stock, we call this a stock market. Now notice that we also call it equity market. And these two are exactly the same thing. They are just two different words and two different names for exactly the same thing. So don't think that stock market is different from the equity market, just a different name, okay? Usually, supposedly, one was more of a British, the other one was more of an American, okay? Just like stock is sometimes called share, okay? And both represent equity. Let's see what else I have for today. So, dividends and all the other stuff, okay. All right, when there is a default, and a borrower cannot pay, the procedure for creditors to get their money back, you go to the court, okay? And there is a special type of court called bankruptcy court. And the procedure is called a bankruptcy. Bankruptcy is a company in default or inability to service your debt. So that's the one meaning of bankruptcy. A second meaning of bankruptcy is a claim in a court on default or inability to pay. So bankruptcy can be considered a claim. Bankruptcy is a state. You are, or the company is bankrupt. And bankruptcy has the meaning of a case in a court or court proceedings to claim your debt, to claim your credits back. All right, so that's bankruptcy. Let's see what else I've got. Issuing, okay. Here, I already said, no maturity. Returns. These are shortest term and highest liquidity, so the return of these is the lowest. These have a relatively low return because they have relatively low risk. This is with one of the basic principles that we discussed in chapter 1, that there's a direct correlation between risk and return. The lower the risk, the lower the return. So these are lower default risk and lower liquidity risk, and therefore they have the lowest returns. Then bonds are somewhat higher volatility, somewhat higher price changes, somewhat higher risk of default. You don't know whether the government, let's say the state of California, in 3 or 10 years will be bankrupt or not. You don't know if they're going to be president next week or this week or not. So a lot of times there may be political situations where the government may decide not to pay. Or the local government has no ability to pay and the central government says no bailout. So these are relatively higher and higher risk, and therefore they bring a relatively higher return. Highest risk is with stocks. Equity presents significantly higher risk, and the expected return is also higher. And there will be times we're going to make a lot more money, meaning a lot higher return on your stock, and at times you're going to make a lot less or negative. You're going to lose. Now, let's go over another concept, which is you have business, and business has economic activity. When you have an economic activity like a business, you have your own restaurant, when you make money out of it, the money that you make is called a, let's write it in red, profit. Profit is associated with business operations, is associated with buying and selling a product, is associated with a service. Profit is associated with a customer, okay, with a paying customer. In investments, there is no profit. Investment, okay, so what is an investment? Investment is considered to be purchase of a financial instrument for increase in price and value. So you buy a bond, you buy a banker's acceptance, you buy whatever stock and all the other stuff. All you get in an investment, and that's key, and that's part of what's coming up in the coming chapters, is called return. You should never confuse profit with return. Return is associated with financial instruments, okay, or investments. Purchase of a financial instrument is called an investment, and profit is associated with business and economic activity. Profit is strictly associated with revenue, which is a sale to a customer. You can sell a product or you can sell a service, and profit, revenues, and expenses or expenditures. Okay? Let's see what else I have so that we finish for today. I want to complete this chapter. All right. Next, I will not discuss a lot. It's actually, there's a little section here on the global financial crisis. I will not be covering it in this class. I'll be covering in investments in great detail, in financial markets and institutions. Maybe I'll cover it in money and banking, but it's not the subject of financial management. Let's discuss the next concept. Part of it is called securitization. Securitization is the process of bundling a number of financial instruments together and then slicing them into pieces. So, securitization is you get 1, 2, 3, let's say 4, 5, 6, 8 mortgages. You take these 8 mortgages, you put them together. Putting them together is called pooling. So you pool a number of loans. They could be credit card loans, student loans, or mortgages. Let's say 8 mortgages. You pool them together and then you slice them. So you get, okay, well, you can do it like this, okay? You pull them together and you get 1 slice, 2, 3, 4, 5, 7, 8. So if you get 1/8 of a slice, you invest in this particular slice. But this slice is all these 8 together divided by 8. What's the difference? The difference is that here, this may blow up is one risk. This may blow up is a different risk, okay? But if you pull them all together, now you pull these risks together. It's not very likely that all 8 or 7 or 6 will default. Out of 8, maybe 1 will default, maybe it will not default. So you pool the risk together and then you slice it into pieces. Sometimes they like to call this, it's a slang, it's not a financial term. If they call it slice and dice. You're slicing and dicing securities, but you first have to pool them together before you slice them and dice them. Okay? So that's the process of securitization. Let's see what else I have. Financial instruments, financial crisis. Alright, when you slice and dice mortgages, we call these So I can add these here, but I can do separately. MBS, standing for mortgage, mortgage-backed security. Mortgage-backed security. So you take usually 1,000, 10,000, 100,000 securities, you pull them together, and then you slice them into $1,000 pieces, and they become mortgage-backed securities. Okay, it could be, the particular security could be mortgage-backed bond, which is a bond secured with mortgages. Okay, now that's very typical. All right. So what was the global financial crisis? Global financial crisis was related to real estate mortgages and real estate mortgage loans, where everybody went crazy about buying real estate because they all believed that real estate prices go up, up, and up forever, which was totally and completely wrong. They all believed that real estate was safe and secure, that it never goes down. But historically, it always goes down after 10, 20 or so many years. You know, real estate, like any other business, has cycles. And people decided to borrow, so they borrowed too much, okay? And financial institutions basically decided to lend. Well, when people default, the financial institution goes literally bankrupt. And it's as simple as that. Again, the problem is that the story is extremely complicated. It takes usually about 1 or 2 weeks to teach the whole subject properly, to understand all the causes of the financial crisis, then to understand what happened during the crisis, then to understand the consequences. And I don't see why and how they put it here early on in chapter 2. So I will not be asking anything related to the global financial crisis, except the part of the chapter which is related to financial instruments, such as what is securitization and a mortgage-backed security. In other words, you are expected for this chapter to understand the financial institutions, the financial instruments, the financial markets. Let's add one more instrument. I already had it before, number 14. It is a legitimate instrument. It's called currency, which is the money of another government. I already wrote it and already explained it. And the financial market becomes a currency market, a forex market. There may be other markets. I'll write it in red. You're not expected to learn now. They're called derivative markets, and derivative markets are associated with financial instruments. Financial instruments called derivatives. So, number 15, these will be only names. You're not expected to know for this exam and for this course. Most likely they will come a lot later in the second part, maybe, maybe not. Options. 16 is called futures. 17 is called swaps. You may have commodity swaps, commodity futures, currency options, currency swaps. And all of these are called derivative markets. Derivative markets. Oh, sorry, derivative instruments. And these derivative instruments are traded on derivative markets. So, again, if I have to summarize, the most important part is the financial instruments. When you know the financial instruments, the markets are simply where the instruments are traded, and the financial institutions are usually associated with these instruments, especially those here of the investment type. Let's see what else I have so we complete for today. That's it. That's everything there is. So, before we finish, all the material up until, including chapter 1 and including chapter 2 will be on the quiz number 1. So, quiz number 1 will include these 2 chapters. Next time, next week, I'll continue with chapter 3 and chapter 4. We'll go through everything with chapter 3 and 4. And quiz number 1 will be, what days do we have? We started class.
Thursday we have.
So it's we have classes on Tuesdays and Thursdays. In what is week 4? Week 4 is like the week after end of classes. So 21st, 22nd, what day?
22nd.
22nd?
Yes.
All right. So November 22nd. What date? Is it Tuesday?
Yeah.
Tuesday. Quiz 1, please. Again, that's very important to record so that, I didn't understand, right? November 22nd, Tuesday. Quiz 1. Chapter 1 and 2. 10%, okay? That should be about 7, 8, possibly 10 questions. Some a little harder, a lot of more easy. These are all questions. Like, what are the common characteristics of money market instruments? Okay, that's a harder question. The simpler question is, what is commercial paper? Explain commercial paper. What is a corporate bond? Okay, which are the main types of bonds? And I have to say these are treasury, municipal, agency, and corporate. Okay, it may be define and explain the main types of private equity firms. And it say venture capital, and explain, and leverage buyout, and explain. So most of the questions will ask for only one simple explanations, but some of the harder questions will be asking for 2 or possibly 3. Okay. I may ask a little trickier question like, what's the difference between a mutual fund and a hedge fund? Okay. Well, what's the difference between a mutual fund and an ETF? Where they're kind of like almost the same. Okay. One step trickier question is the difference between commercial bank and investment. Okay. Now I could have added over here, number 10, not required in this class, no questions about it, central bank. Okay. So these are the types of questions that you should expect from number 2. Now, let's go back to chapter number 1 is, okay, well, what is finance and why study finance? That's a simple question. What is finance and why study? Okay, what's the benefit of studying finance? All right. Explain the 3 main types of business organizations. Don't confuse business organization with financial institution. So, you got to tell me the 3 names and what each name means. Okay? I don't expect something extremely complicated. Okay? 4. What are the main characteristics of a partnership or of a corporation? What are the functions of a treasurer? Or the functions of a controller? That's the little table. I wrote it there on the board. What are the main goals of a financial manager? What is the main goal of a financial manager? Okay? And probably most questions from chapter 1 will come on section 4, the 5 basic principles. What does it mean, time value of money? What is the risk-return trade-off? Okay? What is the cash flows are a source of value? In other words, if you have real estate, the only value real estate has is the cash flow that it generates. Real estate value is determined entirely by the rents which the property can generate. And rents go up and rents go down. And they go down with the economy, they can go down with the neighborhood, they can go down with crime. You know, there are 10 or 100 reasons why cash flows of a property can fall, okay? And yeah, individual response to investment, that's pretty much it. All right, that's good enough for today.